This pattern is a powerful tool that can assist us in identifying potential reversals in the market. The matching low pattern consists of 2 candles, and its appearance suggests a potential bullish reversal. Here is how it unfolds. The first candle is a bearish candle with a significant downward move, characterized by having no lower shadow. This signifies strong selling pressure. The second candle is a bullish candle that opens at or near the same price level as the previous day's low and has no lower shadow as well. It closes within the range of the first candle. This pattern indicates that buyers have entered the market, pushing the price higher from the previous day's low. It suggests a potential exhaustion of selling pressure and a shift towards bullish momentum. The bullish mat hold pattern consists of 5 distinctive candles. First, we have a large bullish candle with a high body-to-wick ratio, signifying strong buying pressure. Next, we see a gap-up opening followed by a bearish candle that closes below the opening price, creating a temporary pullback. The pattern continues with 2 more smaller bearish candles, each suggesting weakening selling pressure. Finally, we witness a breakthrough, a substantial bullish candle that closes above all previous candles in the pattern, confirming the resumption of the upward trend. While the mat hold pattern can be a reliable signal, it's crucial to remember that no pattern guarantees success in trading. To maximize your chances, consider incorporating other technical indicators and implementing risk management strategies. Identify the pattern within a strong trend, as it increases the likelihood of a successful continuation. Pay attention to the size of the second, third, and fourth candles. Smaller candles indicate diminishing selling pressure. Confirm the pattern by ensuring the fifth candle closes above the opening price of the first candle, reinforcing the bullish sentiment. A long-legged doji is a single candlestick that has a small real body and long upper and lower shadows. It is a sign of indecision in the market, as the bulls and bears are evenly matched. Long-legged doji can occur at any time, but they are most significant when they occur after a strong trend. This is because they can signal a reversal in the trend. For example, if the market has been trending up and a long-legged doji forms, it could be a sign that the trend is about to reverse and the market is about to start trending down. Long-legged doji are more likely to be significant when they occur at support or resistance levels. The ladder bottom pattern is made up of 5 candles. The first 4 candles are all bearish, with lower closes than the previous candle. The 5th candle is bullish and gaps up from the 4th candle. This gap up indicates that the bears are losing control and the bulls are starting to take over. The ladder bottom pattern is a relatively rare pattern, but it can be very profitable when it does occur. If you see this pattern forming on your charts, it's a good idea to consider taking a long position. To find more successful entries, remember, the pattern is more likely to be successful if it occurs at the end of a downtrend. The pattern is more likely to be successful if the 5th candle is a large candle. The bearish kicking pattern consists of 2 distinct candles. The first candle is a bullish candle, indicating a previous uptrend. However, the second candle completely gaps down and opens below the previous day's low. This sudden shift in momentum suggests that the bears have taken control of the market. But there is more to it than just the gap down. Pay attention to the size difference between the 2 candles. The second candle, the bearish one, is usually much larger than the first bullish candle, indicating strong selling pressure and potential further downward movement. As traders, it's crucial to recognize the bearish kicking pattern, as it can signal a potential trend reversal or continuation of the bearish trend. By identifying this pattern, we can plan our trades and take advantage of the bearish market conditions.